Welcome to Buy, Hold, Sell. My name's Matthew Kidman, and today we're talking about market corrections. And boy, have we had a market correction. Since the end of August, the Australian market at one stage was down about 12%. It's recovered a little bit, but it has been a pretty hairy ride. And here to talk to me about it are two of our best and most famous guests, Ben Rundle from NAOS and Roger Montgomery from Montgomery Funds. And Roger, we'll start with you.
Sure.
This sell-off that we peaked in August, came right back, probably bottomed at the moment, back end of October. Just a correction, or is there something lurking? Is there an evil creature out there that's going to come
Well,
and get us?
I don't know about mythical creatures, but I do think that the correction hasn't brought the unjustifiably expensive companies back far enough. They've got a lot more to come off before they represent anything resembling value. And even high quality businesses, some of them have fallen 20, 30%, they're still not cheap. So for value investors, it's hard to say that this is a gift. I think there's more to come. I think we've got a catalyst next year in $480 billion of CCC rated junk bond debt due to be refinanced. That's a credit market record, and then another $500 billion the year after. And corporate credit conditions have changed materially since that money was extended to those businesses. So I think there are some issues.
You're still bearish then?
I'm cautiously optimistic.
Of course you are, but we've got to be circumspect.
I'm always optimistic, but very cautious at the moment.
Ben, okay, what camp do you sit in? We all through it, get long, get strong, or just hold your cash, find some safe places to hide?
Yeah, well, a few weeks ago there was a lot of people who were bullish out there, and now they've all of a sudden turned very bearish. I think Roger's point is spot on. I mean, I look at the credit markets when determining whether I want to be in the equity markets, and where we sit at the moment, there are, as Roger pointed out, some worrying signs in the credit markets, but largely at the moment they're still functioning okay. And I look at where the equity earnings yield sits for Australia and the US market, it's about 6%. And if you compare that to bond yields, it's around 3% or a bit over 3% in the US and below that in Australia. So earnings double where the bond yield is. That's enough of an equity risk premium for me to be okay with owning equities. But I think you need to be very selective, because a lot of those high quality, high PE names, I agree with Roger, I don't think they've come down far enough yet. But there are pockets where I think you can find some things to buy.
In fact, sorry, Matthew, rates can rise off the back of these companies defaulting, or off the back of the companies not getting their credit extended or refinanced. And so, it could be a case of the tail wagging the dog. And that's what I'm most concerned about.
Okay, well, let's just get down into a bit of nitty gritty. What in this sell-off, what actually held up, and what do you think is, if you are a bit bearish and you are worried about those names that had big multiples, where do you move to, given what we've seen and what the market's telling you?
Yeah, so there's a few things. So at NAOS we play around the small cap area of the market, and what we've seen there is, particularly from the asset allocators, is they become a lot more, they become a lot quicker to move around their mandates. So I think in the last week we've heard around 3 or 4 mandates being lost. So the stocks that are kind of market darlings or well held amongst the small cap managers are the ones that have been hit the hardest, and they're also the ones that generally sit at the higher level of a PE ratio, because the more money that's piled into them, the more confident people become, and they're the ones that have come back the hardest. In terms of where we sit at the moment,
stay away from them for the moment. Feels like.
Yeah, like in terms of where we sit at the moment, I think probably the biggest area of the market that worries us at the moment is the Australian consumer. Credit conditions for the consumer have definitely changed, and we've seen that in consumer confidence. So if you can own stocks that don't have that sort of exposure, like an example that we've bought recently is ServiceStream, where they don't have any of those macro exposures, the free cash flow of the business is very strong, the balance sheet's very strong, so you can tend to weather the storm a little bit better in stocks such as those.
Okay, Rog, cautiously optimistic. That means you must know somewhere to go and hide.
Yeah, look,
I think we've seen what's been clobbered, and we've seen things that have held up better. So
I think there are companies like Challenger, for example, that have fallen prior to this latest sell-off, and so they were reasonably resilient through the sell-off of particularly the fast-moving names in the high-tech space. I don't think it's really high-tech, but the Afterpays of the world and the Appens and the Altiums and the WiseTechs of the world, they're the ones that have come off the most. Because their prices were unjustified by anything other than momentum. I wouldn't want to go near an Afterpay, for example, for the same reasons. I think retail is going to be tough next year. We've already seen a significant drop in housing activity. By that I mean sales of properties. And when people aren't buying properties or apartments or houses, they're not fitting them out with furniture and appliances. So we've seen Beacon Lighting, we've seen Harvey Norman, Nick Scali, all of those companies have said the first quarter of 2019 is tough. And I think it's going to get a lot tougher because credit conditions have tightened. We've got people with maximum levels of debt. They can't extend themselves anymore. So I think we could see a decline in residential building activity resulting in less payments to tradies. And that's the construction industry third biggest employer in Australia. Retail's the second. And so we could see it flow back to retail next year.
Okay, that tells us where not to go for the moment.
Yes.
Where should I go if I've got to be invested?
Believe it or not, it's darn boring talking about it, but I actually think the banks' share prices at the moment, the big four banks, I think they're factoring in either a recession or some sort of GFC type event at the moment. They seem very, very well priced, given the outlook for NIM and given the outlook for credit growth, which I know is under pressure, but the share price has factored in even a worse scenario. If that scenario doesn't transpire, then the banks look reasonably good.
Okay, terrific. Ben, what about that old asset class called cash? Is that an option?
That's performing okay at the moment, isn't it?
It's doing okay.
Despite
2%'s better than minus 20.
Yeah, that's right.
So what do you think over the next 6 to 12 months, that medium-term view? Pretty wise to keep a fairly high level of cash, depending on your mandate?
Yeah, I think if you can keep a high level of cash and remain cautious and disciplined with what you buy, I think when you go through these market sell-off type events, it's a pretty good opportunity to review the portfolio and say, okay, well, which holdings am I not that confident about, or do I see potential risks coming up? You can move to cash and potentially even buy the stocks that you prefer to have. So yeah, look, I think we've seen cash holdings go up significantly in the last week or so, and they'll probably stay that way, as I think people will probably be a little bit gun shy to put that cash straight back to work.
Nothing like a market rout for people to dust off that old word, caution.